Hi everyone, welcome back to One Finance, and in this video we're going to cover the January performance of the portfolio. Here's the usual disclaimer, and then we jump to our discussion points. So we have a very quick market update, we have interest rate and inflation, we have major currencies, and also the stock market major indices. And for the portfolio review section, we will jump to the January performance, the usual dividend yield and trading results, geographic and sector exposure, and as well as the risk management of the portfolio. So for the quick market update, we have here the US interest rate and inflation. So the dotted line here is actually the inflation rate of the US. If you're going to look at here, sometime in July last year, it peaked around 9% at least, and then now it's currently at 6.5. Although the target of the Fed is around at least near 2%. Now, for the US Fed rate or policy rate coming from last year, that's around 3%. Now it's actually at least for 4.5%. So we can see here that we have an easing inflation, but the policy rate or the interest rate of the US may actually stay above 4% until until the Fed meet their objective of stable inflation at near 2%. So now this scenario actually triggered like a celebration of the market because they are actually expecting slower hike or pace of the Fed in terms of hiking rates. And because of this, you can also see the impact of um, lower inflation expectation in the dollar index. So if you're going to look at sometime here in July, it actually peaked around while the inflation is actually around 9%, the index is actually around 108, and then sometime in September it actually peaked around 114, but now it's kind of trading at 101. So we are seeing a weakening dollar because of the slower expectation of the Fed in terms of hiking rates. Now we actually like seeing a very similar movement here in the eurozone, but there's some sort of delay. Now for the eurozone inflation, we have the blue line here. It's actually around at least 10%, and we saw these. I think two periods that we're seeing an easing inflation, but then again, the interest rate, the ECB actually started hiking rates last quarter last year, and from around 2% now 2.5%. So again, this is still considered as an elevated inflation environment. So that's why they wanted to see inflation to really stabilize near the pre-COVID before the ECB will start to um, cutting rates. But because of this aggressive movement of the ECB, you can see here that coming from September last year, the euro actually started to uptick or gain strength over dollar. Okay, coming from a parity of sub $1, now trading at 1.09 as of this review. Now, however, in China, okay, the largest economy in Southeast Asia is, I guess, but if you're going to look at here, they have a very different picture in terms of the policy rate and inflation. So inflation is actually very stable near 2%. Okay, while the policy rate is below 4%. So you can see here that they have easing inflation, okay, since 2020, and then it started to uptick coming from here, maybe a second quarter in yeah, first half 2021, and now that's from at least 3% now around oh no coming from sub I think that's sub 1% now at 2%. Okay, so very interesting figure here for China. And if we're going to look at later the large cap companies of China, coming from the crackdown of the of the Chinese government to the banning coming from the US and other countries, you will see a lot of potential upside for China's large cap, particularly the tech sector, tech companies. Okay, so we jump to their currency. We all know that we have weakening dollar since last quarter last year, and very much the same here. You're looking at USD CNY, and coming from at least 7.2, 7.3 last quarter, November last year. Now it's currently trading at 6.7. Okay, so we have the weakening dollar, stronger CNY as well. So we jump to the stock market benchmark indices. So you're looking at the blue line here, the S&P 500 index. We have a proxy here, the SPY. So coming from pre-COVID, this level here, and now you're looking at that level. So it's still providing us an uptrend coming from this base. Now for FTSE, this yellow line here, pre-COVID around this level, and if you're looking at least there's a sideways movement, but at least you still have an uptick coming from the pre-COVID level. Now try to look at China here. China large cap. Okay, from here, this is the pre-COVID 2020, and it actually dropped down during the peak of the COVID wave, the first wave, and then it actually went up here, skyrocketed in 2021, and then boom, here it's actually at the bottom, even lower than the pre-COVID level. So that's why I can say that there's a lot of potential. Okay, not a guaranteed you know uptick, but there's a lot of potential in terms of large cap players in China, particularly um, the Chinese ATM. We have Alibaba, Tencent, and Meituan. So we jump to our portfolio review for Mabuhay Fund. We have here our performance for January. That's 5.96. And if you're going to look at the performance of the S&P 500 index, that's actually around 5.8. So that's an outperformance. And the S&P 500 is currently, as of end of January, that's around 4,000, just above 4,000 level. For the dividend yield, our target again is at least 10%. So we are coming a bit short. That's 9.72 because of the added, some of the newly added assets. Nevertheless, we have our trading results here coming from 30 days up to the 1 year time frame. You're looking at a very high profitability ratio, at least above 80%. So that would translate to 80 or close to 90, meaning 9 of 10 trades are executed with profit. Okay, so that's the quick interpretation there. And then you're looking at here the actual realized gain percentage of those trades executed. And then for our geographic location, US, the largest market, the most liquid, I guess, that's around 43%. And then the rest are spread in Australia, Brazil, and other parts of the world. Now, for our sector breakdown, the real estate, again, REITs are part of our strategy in terms of delivering annualized dividend yield of at least 10%, and the distribution frequency is every month. So exposure to real estate and REIT is very essential. But we also see some opportunities in looking at how the Fed and ECB would soon ease their interest rate hiking or started to um, cut interest rates. So that's why we're slowly building positions in some growth or tech companies. Okay, so for our risk management, we have here our target is actually 5. So we can see that a couple of months we actually hit our max target of 5. But again, we're going back to the normal average of 4 or at least of 5 in terms of average risk score. And then the max drawdown for daily is at least less than 5%. So we're still intact, we're on target. And in terms of the classification of assets as to the risks, we can see here that 57 to or close to 60%, those assets are classified as low risks. Very low risk, we have at least 10% allocation, and for medium risk, we have 25. Now, medium risk and high risk assets. These assets are actually held for trading. So these assets are known to as a growth stock or um, tech companies. So I think this is the last slide for our review in this video. So thank you very much again for tuning in. And if you like this video, kindly consider dropping a like, share, and subscribe also. And remember to follow us in eToro.